Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. If you're looking for stronger conviction in your investment ideas, then you're not alone. The rise in U.S. stocks is giving bulls and bears a deer in the headlights type of feeling. And if you're especially worried about missing something that isn't showing up in your current analytical tool set, then the StarMine text mining credit risk model could help. Here's why. The text mining model adds a missing dimension for analysts sifting through piles of company-related text documents. Although the model primarily forecasts probability of default in blue more accurately than the basic Altman Z-score in red, it can also help equity analysts and managers. We use StarMine screening to find companies with higher default probabilities in the bottom 10% of text mining credit risk scores. Long-only investors might avoid them, although they might appeal to short sellers. From the screening results, we selected beaten-down stock Donnelley, best known for printing telephone books. With 28% of shares outstanding sold short, it's a favorite for short sellers. But the perceived cheapness may also attract the long-only value crowd. Fundamental analysts pride themselves in finding key information in text articles in the four categories of transcripts, news, SEC filings, and broker research. The text mining model adds a quantitative rank to what has historically been a qualitative activity. Donnelley scores only a 5 in the 1 to 100 scale. While the broker research component scored a 33, the three other components fared worse. Earnings call transcripts scored a 9. The news component scored a low 3 out of 100. Recent filings earned a 6. Trying to figure out which company documents to read can be a hit or miss proposition. The text mining model helps identify the most important documents out of potentially hundreds by scoring each one from a bearish 1 to a bullish 10. Take a look at Donnelley's August earnings call transcript. During the call, an analyst asked management about debt reduction and potential bond buybacks of the firm's high-yield debt. That document scored a bearish 2 on a scale of 1 to 10. After identifying Donnelley as a cause for concern using the text mining model, we then turned toward the fundamentals using StarMine. Operating profit margins in the blue line have lagged since coming in around 10% in the fourth quarter of 2008. They're slowly inching their way higher, though they still lag industrials margins in the gold line. Donnelley's debt-to-equity ratio skyrocketed to 328% at the end of 2011 from 153% in 2010. One key concern is the $1.22 billion underfunded pension obligation at 115% of equity. Shareholder equity dropped due to acquisition-related write-offs. Arguably, the bear case seems already priced into the stock. This helps the value case for bulls. An improving economy could help performance, but so far, a 9% dividend yield isn't juicy enough to attract more buyers. Short sellers may well feel encouraged with Donnelley's low score in addition to their own analysis. For the Thomson Reuters Idea of the Week and Alpha Now, I'm John Cozy.